Ladies and gentlemen, buckle up. What we're about to dive into could rewrite the rules of global finance. A leaked document allegedly originating from one of the world's largest asset managers. BlackRock suggests they're preparing to integrate Ripple's XRP ledger into the backbone of cross-border payment systems. If you thought institutional adoption of crypto meant Bitcoin or Ethereum, think again. This could be nuclear scale. Today, we're exploring that alleged memo, what it means for Swift and Forex, how whales are reacting on-chain, and why a $500 price for XRP might not just be possible. It could be conservative. First, let's talk about the memo shared anonymously across private financial messaging groups. It's labeled BlackRock Ripple Integration Strategy. The formatting looks authentic blurred headers, internal project code names, and references to executive-level sign-offs. Key phrases jump out: Phase 1. XRP settlement pilot. Phase 2, full Swift transition, and Phase 3, integrated FX management via XRP pools. Even though the document is heavily redacted, enough remains visible to raise legitimate eyebrows if legit. This shows BlackRock is not simply dabbling. They're seriously positioning XRP as a replacement for Swift within their institutional operations. So we'll walk through each page's key visible lines and what they imply. No speculation here. Just a straightforward analysis of what's actually legible. Now, why would BlackRock even consider dropping Swift? Well, it's because Swift is really starting to show its age. Settlement times can stretch over several days. Fees just keep stacking up across multiple correspondent banks. FX risk piles up too. The real-world performance just doesn't match today's global commerce demands. Think about it, $7 trillion in daily currency flows, with only minor improvements to speed and cost. But contrast that with XRP settlement happens in seconds. Costs are measured in fractions of cents, and you get programmable liquidity with Ripple's on-demand liquidity network. Suddenly, the memo's mention of XRP pools to reduce FX exposure looks way less like puffery, and a lot more like some serious institutional heavy-lifting whales are already acting independently of hype on-chain. Analysts have tracked more than $1 billion worth of XRP flowing through large wallets. Over the past few days, the sequence is striking. Leftward-linked wallets receive massive deposits, then sent to custody or cold storage. Shortly after, one group moves 600 million XRP into what appears to be secure institutional cold storage. The same day this memo first appeared, the pattern of accumulation points to strategic positioning ahead of a potential announcement. This activity signals insider awareness, or at least confidence in something big coming. We'll provide a narrated walkthrough of on-chain charts, wallet clusters, and timing synchronization, all overlaid with chart visuals. Let's do some math. If XRP is meant to replace even just 10% of daily global Forex settlement, a conservative figure that's roughly $700 billion per day, flowing through XRP-based rails at current supply levels and factoring in required liquidity buffers. Analysts estimate an XRP price floor of around $500. That's not fantasy chatter. It's throughput-driven valuation. And that doesn't include potential speculative premium from being perceived as a global digital reserve currency. We'll peel back the math in detail, showing how incremental adoption scales through network effects and real on-chain utility. But no shock dies here. Let's overlay reality so far. No official confirmation has come from BlackRock, Ripple, or central banks. The document remains unverified. That said, the leak coincides suspiciously with BlackRock STEC's recent filings around digital asset initiatives, their spot Bitcoin ETF launch discussions with Ethereum governance groups, and partnerships with financial infrastructure firms. The timing aligns. We'll break down those filings and announcements, placing them on a timeline that mirrors the memo's internal calendar. It doesn't prove authenticity, but it suggests plausibility. For balance, we must address risks and counterarguments. What if the leak is disinformation? A scripted rumor aimed at manipulating markets? That's entirely possible. We'll explore how rumor campaigns manifest in crypto, how well-organized groups plant leaks to drive on-chain accumulation, and how institutional actors respond or deny. We'll place the memo amidst past crypto misinformation waves and give you frameworks for distinguishing between strategic leaks, false flag operations, or innocent misinterpretations. In contrast, let's review XRP's fundamentals. Ripple's growing ecosystem of more than 120 financial institution partnerships, integrations with major payment corridors, and the rapid growth of its on-demand liquidity functionality. So let's dive into some case studies, like, for example, transferring funds across Asia in 24 hours compared to, doing it in just minutes using XRP real-world anecdotes from CFOs of payment firms, and these are backed by regulatory filings, really help to illustrate the ledger's performance edge. We'll also talk about Swift's modernization efforts like their cross-border payment initiative, those RTGS updates, the adoption of ISO 20022 messaging, and even partnerships with token-based systems. But honestly, despite all these big promises, the underlying rails still well lag behind when we look at these efforts. Alongside that leaked memo, XRP really stands out as both a bold alternative and, a logical partner for institutions that need a supplement to those aging rails. Elon Musk's integration into the meme narrative. Aside here, we're talking institutions moving capital. No hype memes, no tweets, just boardroom decisions. We'll dive into how asset managers assess digital liquidity, infrastructure compliance issues around know your customer and anti-money laundering integration with existing foreign exchanges settlement risk, and how a firm like BlackRock could integrate XRP behind their existing custody silos. As for the whales, yes, it hints they know something, but we must question how whales get access. Did internal docs leak to analysts? Are insiders trading in anticipation of public announcement? So let's break down the institutional flow, how confidential memos sometimes leak within broker chains, how token custody processes actually manage incoming supply, and how on-chain patterns can act as early warning signs. Of course, these are signals, not guarantees. Now let's take a look at the $500 projection from a visual angle, a sort of hypothetical overlay of price versus the adoption curve by plotting out the speculative stamp act and institutional adoption phases. We can explore different path scenarios, like $50, 500, or even 5,000 XRP trajectories, and you know what would really be required at each stage in timeline? We'll make sure to include chart animations for some extra clarity, then we'll explore domino factors. If BlackRock integration is real, the ripple effects could include central bank digital currencies like could currencies actually pegged to XRP. Also, we might see emerging stablecoin design using XRP rails, and even public ownership tokens tied to XRP flows. Next, we'll cover how secondary effects like liquidity mining and validator network participation could really magnify adoption. We'll conclude by giving you a decision framework, basically how to interpret leaks, and align them with fundamental on-chain signals, regulatory posture, institutional filings, and technical adoption. This should help you, differentiate noise from potential nuclear-grade development. And finally, we'll provide the direct viewer call, what actions to consider, how to responsibly follow this story, risk management strategies given institutional involvement, and what forward-viewing signals will validate or falsify the leak. Especially keep an eye on future BlackRock statements, Ripple board disclosures, institutional research papers, and central bank comments. Disclaimer: this video is for educational and informational purposes only. It is not financial advice. Please do your own research and consult with a financial advisor before making any investment decisions.